Now, the increase in economic activity and the easing of COVID-19 restrictions have contributed to rising energy use. The short-term energy outlook assumes that the US GDP will grow by 6.2% in 2021 and by 4.3% in 2022. These macroeconomic assumptions is based on continuing economic growth and increasing mobility with easing COVID-related restrictions. Now, the US crude oil production averaged about 9.9 million barrels per day in February 2021, which was down by 1.2 million barrels from January. In February, cold temperatures caused significant declines in crude oil production in Texas, as well as smaller declines in other states. It is estimated that production outages were generally limited to February and that US crude oil production rose to 10.9 million barrels per day in March and to almost about 11 million barrels per day in April. Now, because of the average price of West Texas Intermediate crude oil remains above $55 per barrel. It is expected that producers will drill and complete enough wells in the coming months to offset declines at existing wells. In addition, it is forecasted that new projects in the federal offshore Gulf of Mexico will contribute to rising production in the US crude oil production and is expected to average about 11.3 million barrels per day in the fourth quarter of 2021, after which it will then rise to an average of 11.8 million barrels per day in 2022. Now, what about the gas? In April, the natural gas spot price at Henry Hub averaged about 6 million British terminal units, which is slightly higher than the March average of 2.62 million British terminal units. Now, the Henry Hub natural gas spot price is at the current level of about, as of today, the current level is of about $2.96 per million British terminal units. It is expected that the natural gas prices will continue to rise this year, primarily as a result of two factors. One, the growth in liquefied natural gas exports, and then two, the rising domestic natural gas consumptions in the residential, commercial, and industrial sectors. So I look forward to having a robust conversation today that would look at all these factors and all the allied associated events that happened within the last 12 months. And I'm happy to have you all here today. Thank you very much.
Thank you, Godswill. Appreciate your brief summary of the current state of the market. And now introducing Jesse Thompson, Senior Business Economist with the Federal Reserve Bank of Dallas. Jesse Thompson. Jesse, if you could briefly introduce yourself as well.
Good morning. Jesse Thompson, here at the Houston branch of the Federal Reserve Bank of Dallas. Well, obviously I'm at home here, blocking out the stuffed animals and Legos that I had to walk across to get here. But I work in energy group and in the regional group, so I'm kind of at where the rubber meets the road for the intersection between energy and regional economy. Most of my work focuses on oil and gas, and I prepared just a couple of high-level summary points, some of which Godswill has already covered, so that'll save us a little bit of time to get to the Q&A, but just sort of setting some of the stage for what I focus on, what I think about when we're talking about this, and I see from some of the questions that have already been sent around that there's going to be a lot of topics here of interest to discuss. And what I do at the Federal Reserve Bank is I draw in information on oil and gas, whether through conversations with industry professionals. I contribute a little bit to our energy survey, which is it's a large survey of oil and gas professionals, E&P and oil field services firms throughout the 11th district of the Federal Reserve Bank of the 11th district. That's the Federal Reserve Bank of Dallas's territory, which includes all of the Permian Basin, northern New Mexico, and all of Texas. All of the Permian Basin, southern New Mexico, northern Louisiana, and all of Texas. So it's shale's a really big part. The shale boom and the oil and gas industry is a big part of what we provide. And those summaries of information, the analysis that I do, all of that feeds into our understanding of how energy is contributing to the regional economy and how we need to be thinking about it ultimately from a monetary policy perspective. And that drills down to a few things: investment, It drills into jobs. And of course, it drills into prices that consumers ultimately face. Now, the data I work with comes with a lag, and I've just got a bit of a sales pitch here. We at the Dallas Fed very much appreciate the input of actual business professionals out there in the real world, making real decisions in real time. The data that we analyze, that we utilize, does not come in real time. It does not reactive to, the developments and COVID policy and other things like that. It's very lagged. And so, especially this past year, we have very much relied on feedback from businesses, not just to understand what's going on, but to color how we respond in terms of monetary policy. And in fact, the many of the lending windows and policies that the central bank has pursued over the course of the last year were informed by reacting to feedback that we were getting from businesses. So if you're interested in participating, there's going to be a little QR code here at the end of my slide deck. It's very short, but as you hold your phone over it and you'll be able to get it. And of course, we'll be able to send that around if you're interested in participating in our surveys. And of course, you can tell me, and tell my bosses how you think I did here today. But we really would like to hear from you and tell us whether or not you're interested in participating in our surveys. So sales pitch done. Let me, again, something similar. I have a little bit different numbers from God's will. So, global GDP up, just consensus economics forecast for April 2021. I didn't quite have the May forecast yet, but global GDP up 5.3% this year, up 4.1% in 2022. So a bit of a slowdown. The US, actually, the blue chip consensus for May was 7%. It's an average of lots of different forecasters, with a bit more of a marked slowdown than God's will was alluded to with his forecasts, with 3.1% next year. And then the way that we're thinking about this, is that this means, number one, if we think about jobs for the United States, US economy, that means we're going to pretty much absorb everybody who's off. If we really do grow this much, then we're probably going to absorb most of the people who are not in the labor force. And that's going to keep some upward pressure on prices and inflation, but it is expected to slow markedly as we get into 2022. And this is sort of how transitory is a lot of the price signals that we're getting right now. This feeds into that. But what does this mean for the oil and gas sector, and in my conversation going forward? Capital discipline, focus on ESG, environmental and social governance, particularly the environmental side, rising wage and price pressures are likely to temper US upstream growth in the remainder of 2021. We do expect more growth in 2022, but there's some interesting stuff that we're gonna have to get into in the Q&A. Would go into that. So the number one thing that I think about, God's will already brought up some great production numbers and outlooks. I like to think about it in terms of jobs. I was born and raised in Houston. We were talking earlier, my grandfather was in the oil business. And so, no one in Houston, everyone in Houston has somebody on their street that is employed in the oil and gas industry, either directly or indirectly in the supply chain. We all know somebody. And I would like to point this out. And when you look at this chart here, this is thousands of jobs nationwide in oil and gas. So this is the way that the obtuse way the BLS, Bureau of Labor Statistics, labels this is mining extraction, oil and gas extraction, and support activities for oil and gas operations. Producers and E&P companies. That's basically what it is. So producers, E&P companies, and oil field services. That's who this is. And a couple of things stand out here. So number one, this bottom line here, start off at home here, this is Houston. You notice the number has come way down. It's leveled off, a little bit of an uptick in the most recent data, but it's leveled off here at a relatively low level, well below where we have been at any point really since the 90s. And for those of you who may have some interest in commercial real estate, suffice to say, the oil and gas industry is not going to be filling any commercial real estate space here anytime soon in Texas. Not much of it anyways, especially not the buildings they built. But if you look at outside of Houston, look at the rest of Texas, and that's really the Permian Basin, the jobs are on the rise. All right. And so if you look at this light blue line here, you can see tracking with drilling and completion activity, you see jobs on the rise. Whereas if you look outside, post-pandemic, you look outside Texas, and this is driven by other shale plays, Bakken, Colorado, and the Marcellus shales. And not to mention, of course, there's still, Louisiana is lumped in there, and there's still offshore and other things going on, but that's been relatively flat. There's some seasonal issues with the seasonality in this data set, the way I have it calculated here, but that's basically flat. It's really the Permian Basin that's driving a lot of the growth and jobs in the rest of Texas. But the industry overall is, in terms of total employment and producing nearly 11 million barrels a day of oil, is below where we were just prior to the shale boom. We're back to where we were in 2010 overall for the industry. So clearly, and those jobs, it does not look like are going to come back anytime soon, unless we get some really amazingly high oil prices and substantial draw to get oil production up. Oil prices, as Guzman noted, are up to pre-pandemic levels. This is supporting a lot of activity. Part of this is because of demand growth, vaccine optimism. Part of this is because of OPEC discipline, holding off several million barrels a day of production. And part of this is just, and part of this is the reopening, right? So there's demand up. There's a broad-based commodity boom going on. This is not just oil and gas. This is felt throughout the goods producing industries, whether you're talking about copper, intermediate chemicals, is a really, chemical industry is seeing substantial price rises right now that rival all of the memes that you're seeing. And believe it or not, they've actually, the price increases in chemistry rival the price increases that you're seeing in lumber and OSB and other things. It really is stunning. I think the April annualized growth rate, for basic organic chemicals was like 250%, with the knock-on effects from the freeze-off that occurred in February. And we can talk more about that later if there are questions. But prices are up at a level that can sustain activity. We've seen drilling and completion track up over the course. You can see there the freeze that happened in February there when you're looking at the frac crew count or this measure of frac crew count. There are others that don't necessarily agree with this, but this is one that I have that's available. And they've tracked up here over the last couple of months very aggressively. We expect this to slow going forward, but incremental increases, right? Where is the increases coming from? Capital discipline rules the day for public companies, particularly larger and intermediate-sized public companies. Private, smaller independents are thought to be driving a lot of the growth going forward because the rest of the industry is lumbering under capital discipline goals. Not spending any more than they've already said that they're going to spend, and their spending plans were based on prices in the low to mid 50s, with most of them having hedged in the high 40s. So I've hedged about 50% of this year's production in the high 40s. But those same companies that are supposed to be driving a lot of this growth also have the most exposure to the recent increases in input prices. So oil and gas industry is late to the input price party, right? So steel prices are up, but OCTG tubing prices, they really didn't start surging with steel price. They have now started surging as activity has really ramped up. And when you're on the services side, there's still a lot of idle equipment lying around, spare equipment lying around that's keeping service costs contained. So that to some extent, that we are wearing through that, but there's still a lot of idle equipment laying around that is sort of keeping that industry challenged. When we look at overall returns, this is usually a very depressing chart. So I'm just going to say, look to the right-hand side of the chart here, particularly as you move into the latter parts of 2020 and into early 2021. You really see the industry sort of getting its feet, beginning to see some returns. Refiners and marketers, of course, doing relatively well with the reopening. So you got the majors and the integrated refiners. E&P companies doing better. In fact, for a brief period here, they were one of the better performing sectors for the first time in over a decade in the S&P 500. Equipment and services, oil field services, again, I already mentioned, still lots of idle equipment. Margins are still extremely low, still very competitive. They're really looking more towards the end of this year, 2022, as a time for margin recovery. So there's still some room for consolidation. We'll talk about that in the Q&A session. Debt markets, we've got some really brilliant minds here on the call, so I'm going to defer to them in terms of detail here. But suffice to say, The credit situation is not as tight as it was. It's clearly improved quite a bit for high yield. It's improved across the board, but it's still a very challenged market. Raising funds is still a very challenged market, and especially for oil field services. And raising money, there's a lot of funds that are really focused on ESG. They're focused on, are you meeting your ESG metrics? Can you show us some progress? We want to invest in renewables. We want to invest in solar and wind, biodiesel, or sorry, not biodiesel. I apologize. Renewable diesel as driving a lot of interest. So that's drawing a lot of the investment interest away from traditional oil and gas, and so the industry is having to deal with that. There's a lot of interesting talk about natural gas, but we're just now beginning to find out how much natural gas we're actually leaking into the air. And if we start to measure that against the carbon advantages of natural gas versus other forms of energy, well, to the extent that recent measurements are right, well, maybe natural gas in a carbon constrained world, and a world where we care about methane emissions, may not be as advantaged against coal as we once thought, without a lot of investment to contain some of these fugitive emissions from pipelines and gathering facilities and gathering networks. Now, this is, I think, they're going to drive a lot of the conversation. And this is a consensus of many different forecasts of consumption going forward. Right? Lots of room to debate where this is going, especially past 2022. But where's the consensus? The consensus says right now we're at about we're a little over 95 million barrels a day, maybe a little bit more, maybe a little bit less. We're going to get here to 99.6 by the end of the year. And by the end of 2022, we're going to be up to about 101.8 million barrels per day. So 2022 is really when we're going to get past, according to the consensus of projections here from agencies and banks and others, including the Dallas Fed, it's really 2019 when we get 2022 when we get back to 2019 levels of consumption. Now, when you crunch the numbers, you think about it, this number is still projected to grow through most of this decade. Some people think it grows into the early 2030s. Some people think with the accelerated move towards electrification and other policy things, that maybe it's going to be the sort of maybe 2028, 2027 when we hit so-called peak global liquids demand. But that's a big open question. Near term, and I apologize, I go out of order here, I got a little excited, but near term, when you look at this, you see my headline here, 6.2 million barrels per day of expected growth over the next 6 quarters. And we're talking about the state of the oil and gas industry. OPEC Plus has, if you believe the most recent IEA analysis, has about 4 million barrels per day on the sidelines. And on top of that, you've got another million and two barrels per day of production capacity in Iran that over the next 6 quarters is likely to come back. Some people think it'll be done by the end of this year. Maybe it'll take longer. Who knows? It's a big policy uncertainty. And on top of that, you've still got OPEC spare capacity that sitting on the sidelines. So you've got nearly you've got maybe 5.5 million barrels a day of capacity, production capacity, that is idle, that could readily come back onto the market between now and the end of 2022. The gap, we think that US production is going to grow. In the Dallas Fed, we think it's going to grow about 300,000 barrels per day, exit to exit this year. So 0.3 million barrels per day, and maybe another 500,000 barrels per day. We haven't formalized the numbers yet for next year, but there's still a gap, and that gap is going to have to come from somewhere. Maybe it comes from Brazil, maybe it comes from Guyana or other countries, or maybe we ramp up more than we think. Maybe we're going to get stronger production growth than we think as we move into 2022, but in the United States. But most of that production is readily available. Most of the production that we're going to need over the next year and a half is readily available from OPEC and their friends. So that's really, I think, going to be a factor that sort of tempers investment in oil and gas in the near term. Because yes, oil prices are $60, but a lot of companies are going to look at that and say, we need to be careful because that production could come back at any time. So overall, this is a quick summary of what I've already talked about, but I really look forward. Here's that QR code I promised. If you hover your phone over that, it'll take you to a link. You can give us some feedback, sign up for our surveys, and I'll email that to Mark, please tell us how we did and let us know if you want to participate in our surveys. We want to hear from you. And with that, I'll relinquish the screen here and we can get on to the Q&A portion and the rest of the panelists. Thank you.
Perfect. Excellent. Thank you for that. And obviously correlated with some of Godswill's statements earlier. So Jesse Thompson, Federal Reserve Bank of Dallas. If you don't mind pulling up that QR code again quickly, I'm sure, I know I missed it, but I'm sure a lot of other people did as well. So if you want to capture that information, and then we'll have our next speaker from FTI Consulting.
You go on ahead and go forward.
Okay, perfect.
Yeah.
Hey, hey everyone, Steve Everly, Managing Director at FTI Consulting. I'm in our Energy and Natural Resources group. Have been here for about 10 years. Actually, May of this year, right now, is my 10-year anniversary exactly. So I focus a lot, I'm in kind of the public affairs world. So what I'm going to be running through here is kind of what is the policy environment and what is kind of the broader public affairs environment impacting the energy industry as a whole, but with a particular emphasis on oil and gas. I'm going to see if I can share my screen here without any hiccups, and then we'll go ahead and get started. All right, did that come through? We got a thumbs up, down? Okay, cool.
Yeah, you're good.
Okay. So just kind of a quick overview here, kind of a quick agenda of what we'll be going through. A general overview of the policy and regulatory environment, kind of the high points of kind of what we're looking at right now in May 2021. We'll go through some key issues. Some of these have already kind of been brought up by Godswill and also Jesse in some form or fashion. And then we'll kind of end with some other issues that some of them have been around for a while. Others might be just sort of on the cusp, things that we're certainly following closely and that we think are relevant here to the discussion about understanding risk and opportunity, obviously, in the industry. So in terms of the kind of the current environment here, there's a couple key facts here and some key things here. I don't want to be, I don't want to just read words that are on the screen, but the upshot here is that the Biden administration in particular has made climate change a central part of its entire agenda. It's not just energy and environment. They call it a whole of government approach. So agriculture policy is seen through the lens of climate change. Trade policy is seen through the lens of climate change. Certainly anything related to energy and environment is seen through the lens of climate change. And that's manifested itself in a number of ways, executive orders, rules, their budget. There has been, a pretty intense focus on rollback of policies from the Trump administration, focused on the energy sector. And the goal here that they have stated, and they were very transparent about this even during the campaign, is reestablishing the United States in a leadership role on this issue. Right now, thus far, there has been some tension between two key constituencies within the Democratic Party and within kind of Joe Biden's coalition, so to speak. And that's between labor and environmentalists. And it has to do with how do you address climate change? How do you enact, kind of bold and aggressive climate policies while also protecting the workers in these in the energy field, particularly oil and gas, but coal, mining, others. How do you protect them? How do you make sure that they are made whole? So you see a lot of talk about just transition and equitable transition, things like that. But it's already come to kind of the fore. There was the cancellation of the Keystone Pipeline. There have been other pipeline discussions that are going on. You're seeing a lot of news about this, and it is creating a little bit of an issue in terms of kind of a give and take between what kind of environmental policy you can have moving forward and who's going to be impacted by that. The other challenge here too is obviously, and we've seen this just over the past few weeks, ensuring the safety and reliability of our infrastructure system. I'll get to this a little bit later. I do have a slide on pipelines and infrastructure, but thinking about how we transport energy, how we get it from A to B, and what that demand looks like. You have to get it from where it's produced to where it's needed. And whether that's a pipeline, whether that's a transmission line, you know, regardless of maybe what our energy system will look like in 2030, 2040, 2100, whatever, in the short term, we're going to need to get those fuels from A to B, and making sure that we have the policies in place that allow that to happen, while also making sure people are safe and that we're setting the foundation for the future that we need, is also kind of a key tension here. Jesse's presentation kind of ran through a little bit of what demand is looking like, you know, kind of the recovery, so to speak. Long-term demand, you know, it's under debate. I think that there's a lot of different ways that this can go. You have the Paris Climate Agreement. You have all of these net zero targets that states and federal governments around the world are enacting. And so there is a question about that. Is that going to run into reality in terms of what people can and can't do? Like, what's the limit? Or is that actually going to be, you know, a ceiling on oil and gas, and that we are going to be looking more at renewables? It's a big question right now. I don't think that's news to anyone on this, you know, in this event, but it is something that kind of undergirds a lot of these policy discussions and everything that we're having right now, because it's that inherent tension of, is this feasible versus do we need to be bold and aggressive? So I wanted to just give a couple of just kind of recent headlines. These are just, you know, largely over the past few months, of how the oil and gas industry and the energy industry as a whole is under intense scrutiny right now. And it's not just, it's by regulators, it's by the administration, it's also by the media. And it's not all, you know, here's why the oil and gas industry is going to disappear next year or something like that. It is, as I also mentioned, you know, what's happening to workers, what's happening to some of these blue collar folks who build pipelines and do a lot of the necessary infrastructure work around the country. What does their future look like? There have been a lot more stories on that recently than I have seen, certainly over the past 10 years. Arguably, because if you're a cynic, you could say maybe the attacks on those things are higher than normal. But suffice it to say, it's part of the broader policy discussion, and how some, you know, policies they're not enacted in a vacuum. There are a variety of constituencies and things that obviously happen. And so I thought this was kind of helpful to just see where the news coverage was going and where it has been. So a couple of key issues just to kind of go through. And at the top of the event here, Godswill ran through a couple of 3 key events from just yesterday. I actually got this slide finalized 2 days ago. And so after yesterday, I honestly thought about just scrapping the whole thing and redoing it, but I decided not to do that. But this topic itself could have been the entire presentation, even just based on the events yesterday, in terms of shareholders, what they want to see in terms of the energy transition, in terms of, you know, disclosing climate risks, in terms of adjusting your business, you know, the court ruling over in the Netherlands. You know, what does that mean for, you know, products all around the world? Is that a precedent? Is that limited? There's going to be a lot that comes out of that that could render a lot of what we're discussing even today moot. But suffice it to say, this top line here, investor demand for climate-related risk disclosure has grown tremendously. And then the supplement to that is, this is where things are headed. This is not something that's a flash in the pan. This is not something where this is just kind of the flavor of the week and this is kind of fun to do, and then in a year from now, we won't be talking about this. This has been a long time coming. And you know, how companies are adjusting to that and how companies are addressing that is not just a public affairs component, but it actually has to do with their valuation now. Our capital markets team here at FTI has done a lot of research on this. And they've found that in many cases that markets are already effectively pricing in climate-related risks and opportunities. And so, you know, so-called climate leaders are actually outperforming companies that are considered climate laggards. Now, again, you look back just 5, 6, 7 years ago, it was sort of like, oh, are you a leader or laggard on climate? Like, that's sort of nice to have. But, you know, what are you actually doing to make us money? It's a little bit of a different story now, and it has changed very quickly in that regard. So I listed a couple things here about, you know, kind of what the SEC has been up to, you know, and some of the specifics on that. There was just the recent announcement just here from about a week ago with the administration, with the new executive order. about disclosure of climate-related financial risk. Again, that doesn't happen in a vacuum. That's been a long time coming. That's been a years-long process to really put a lot, to increase focus on this, and you know, some would say, you know, activists even just pressuring companies and pressuring firms to do this. But this is not just, you know, tree-hugging environmentalists saying don't do this. Like this is actually people on the street. These are actual, you know, sophisticated investors who are looking at this, looking ahead 20, 30 years and saying, how are we addressing this risk now? Because long-term, we want to make sure that we're getting returns for you know, our portfolio. You know, in the climate conversation, particularly in an oil and gas context, methane is kind of that top issue, right? It has, and this is something also that, especially over the past 10 years, has really grown in intensity. It is central to what we talk about from a climate context in terms of policy, especially for the oil and gas industry. There has been increased scrutiny. There's been a lot of research recently that's kind of helped us better understand what emissions look like. I will say, you know, there is contradictory research out there. There are plenty of studies that show that it's low, that it's manageable. There are others showing that it's way too high. Some of them are actually looking at the same data and just coming to different conclusions about what that actually means. But again, from a policy perspective, whether it's high, low, whatever, it is a high priority for the folks in power right now and for government officials, not just at the federal level, but also at the state level, we're seeing as well. One of the big events that happened just recently, the Senate used the Congressional Review Act to actually roll back one of the Trump administration's methane rulemakings, which was considered itself a rollback of a methane emissions rule from the Obama administration. So the Congress has essentially said, you know, the Senate at least has essentially said, we're going to go back to what that, you know, to what it was. And you actually saw a lot of large companies come out actually in support of that CRA, of rolling back those rules. And that's been a big change over the past 5 years as well, as a lot of companies and even some of their associations here in DC have kind of shifted their tone on this and have actually come out in support of methane regulation. They all have their own, you know, specific needs and how they want that policy to be crafted, but directionally, there's definitely more regulation of methane coming as opposed to less. It's more of a question of when as opposed to if. And another interesting thing here too is, you know, PHMSA, the acronym that I can never fully spell out in my mind, but they regulate pipelines. They created some new staff that are focused exclusively on methane. And I think that, again, you look at the direction here, you just want to understand, you know, where are things headed. And I think that that's another data point to confirm how that's going. And the last point here, I think is as I'm looking through this, you know, there's the US context, but I think this may be actually one of the more important ones, is the focus on this internationally from other companies, or excuse me, from other countries, because that has a direct impact on US exports. Countries around the world are actually looking at what LNG are they importing, what oil are they importing, and they want to know that that's being produced under the best possible regime. And that can be rules, that can be leaks, that could be a number of different things. There was some news late last year about you know, a contract in France that had got canceled from a U.S. you know, project. You know, this is now having an impact, not just in terms of like what the U.S. policy discussion is, but the U.S. is now being affected by what other countries are doing on this, because it impacts what is a key part of the U.S. industry's, you know, potential growth is obviously in these export markets, these growing markets around the world. And if they're putting more scrutiny on these things, that obviously has an impact on how we do business here in the United States. Climate litigation. There have been a number of cases filed against typically the larger oil and gas companies. Some of them have looped in some of their trade associations as well. Essentially what they're saying is that they're seeking damages for the impacts of climate change, and basically saying, okay, the company, the folks that produce these fuels that are causing climate change are responsible, so they owe us this amount of money. You've seen an increase in what's called attribution research, where people are kind of reverse engineering carbon emissions back to individual fuels and then attributing individual production numbers to companies and how much their emissions they had. So this is what they would be responsible for in terms of climate impacts. A lot of it, you might call it cutting edge, you might call it silly, depending on what side of the issue you're on. But suffice it to say, there's a growing focus on this, particularly at the local level. Again, this isn't really the federal government. These are some states and larger municipalities. You have several law firms that have partnered with different groups that are approaching municipalities, offering contingency agreements with them to say, hey, we'll run this case for you. We won't get paid unless you win. And these are multi-billion-dollar suits. So essentially they only need one. It is part of a broader campaign. I don't want to put on a tinfoil hat here, but there are foundations and other folks that are funding some of these efforts. And they have also supported some of that research to support it. So there is a campaign afoot here, but there have been some sort of procedural wins and losses for both sides in the court. So it's not as if this is necessarily a slam dunk. But it is something that has been growing, and it's going to continue to grow. Even if there are losses, because even from a public affairs perspective, there's sort of a benefit in getting headlines about the industry's cause of climate change. So I mentioned earlier pipelines and infrastructure. Any major pipeline today is going to face, at a minimum, far more scrutiny than it did just a few years ago, and quite possibly a national debate. If you're building an interstate pipeline, you almost should prepare for national scrutiny on it. And I don't just say that because I work in public affairs and that we help the industry with that. I'm not trying to make a sales pitch. I'm just trying to talk about what the reality is in terms of what kind of scrutiny these are under, and what kind of issues are facing. Everything from eminent domain to environmental justice, which is also a growing point of emphasis in terms of how projects are being reviewed, not just in oil and gas, but all energy. We talked earlier about methane emissions, climate impacts, increased focus on that from FERC, the Federal Energy Regulatory Commission. So any of these projects, and that gets back to what I was saying earlier also about how are we going to move these fuels from A to B? How are we going to get them there? In some cases, we're seeing increases in rail shipments. In Massachusetts, they've been pipeline constrained there. They import LNG from Russia occasionally. So it is kind of interesting how this plays out and what that actually leads to. Another thing here, just to kind of emphasize, and I just saw it literally this morning from the Associated Press, and that has to do with cybersecurity, which those of us here on the East Coast certainly understand that issue a little bit more maybe than we did even just a few weeks before. But the headline from AP this morning is U.S. pipelines ordered to increase cyber defenses after hack. And it has to do with what the administration is requiring them to do. I haven't carefully reviewed that, but provided it is something that's just coming out, and cybersecurity is going to be an increased focus, particularly for pipelines, but I think there's also a context here for power lines as well in the electric markets. I want to be cognizant of time, so I'm going to try to skim through some of these a little bit quicker. Local natural gas bans, 5, 6, 7 years ago, the debate was over fracking at the local level. Now you have a lot of localities pushing for bans on natural gas. A lot of them are in California, but there's also some other states. Massachusetts, Colorado has pushed forward. They typically, the response to these is typically, one or two other cities either follow through or states are passing consumer protection laws, consumer choice protection laws, where they say you can't ban any of these fuels. You have to allow this. You can't discriminate against one of these individual fuels. One interesting way that they might be kind of getting around that is that they're not always making it explicit. You can, set the codes at, for buildings and houses at such a level that it actually makes it impossible for natural gas to meet it, even without actually using the word or the term natural gas in whatever you're drafting up. So another kind of creative way that's kind of getting through that. And I will also say here too, that a lot of this discussion is about climate change, but an increasing area of focus is actually indoor air quality. And talking about what kind of emissions come from a natural gas oven, stove, furnace, predictably, you do have some restaurants that are getting a little bit concerned about that, because they say, hey, we want to address climate change as much as anyone else, but if you take away our gas cooking capabilities, we don't have a restaurant anymore. So kind of an interesting way that debate's shaping out. This federal lands development on federal lands has been has probably gotten as much, if not more, ink in terms of energy policy over these past 5 years than anything else. The administration did introduce kind of a moratorium on new leasing on federal lands, that's onshore and offshore. They telegraphed this during the campaign. This is not anything that was sort of a surprise. Joe Biden said during the campaign that he opposed development on federal lands and he wanted to ban. You have seen some pushback from some pretty prominent Democratic governors in energy producing states, understandably. And the current process right now is Interior is reviewing a whole bunch of comments that they received after a forum a few weeks ago to kind of determine what the next steps look like. But suffice it to say, everything right now is on hold for federal lands. It's particularly troublesome for a state like New Mexico. Over half of all their production comes on federal lands. And it's about a third of their oil and gas is about a third of their budget. So irrespective of where you fall on it, when you're talking about equity, if you're talking about sort of, just transition and everything else, there are a lot of questions wrapped up in that as well. So, and the last thing here, just kind of some other issues that are on the horizon. I don't like putting environmental justice in here as sort of an afterthought, but it's something that just sort of goes through everything. It's kind of an all-encapsulating thing. I debated whether I should put that as sort of a first slide or as something to just kind of reinforce at the very end. I obviously settled for the latter. Grid reliability, we talked about pipelines and infrastructure, power lines as well. I moved out of Texas 2 years ago. I didn't have to go through the big freeze earlier this year, but again, we're all going to be dealing with that in some way, form or fashion, just as fuels change and as production changes. National Environmental Protection Act, NEPA. Oil and gas industry has known about this law for a long time and raised concerns about it. What's interesting now is that renewables are also kind of raising some concerns about it as well. The wind industry actually supported the Trump administration's proposed reforms to the rule. If you can't build a pipeline across multiple states because of NEPA, you're probably going to have similar trouble with high voltage transmission lines as well. Hydrogen, low carbon fuels. There's a lot loaded in here, but hydrogen is one of those issues that could be a potential bridge between labor and environmentalists. It doesn't emit any carbon when it's burned, and also you need to have pipelines to move it. So if you think about the labor unions that build pipelines, they're going to be probably supportive of it. Existing natural gas lines, at least theoretically, could also be used for hydrogen potentially down the road. And what's the future of liquid fuels look like? Interesting moment coming up with the renewable fuel standard next year, in that the volumetric requirements, they don't come to an end, but EPA then has discretion moving forward. So you can see kind of an interesting battle coming there between electric vehicles and the biofuels industry, each of which has some very interesting and entrenched interests based on geography. So there could be some interesting political fights that, which I kind of am interested in addition to just what does the future of transportation fuels look like. Carbon taxes, border adjustment taxes, there's a reason this was put at the very end. I don't think it's very likely that we're going to see a carbon tax, but the discussion about it has been way more intense than before. And this idea of a border adjustment fee is also coming into sort of fashion as other countries are considering that, particularly in Europe. So just something to kind of consider and something on our landscape. So.
Excellent.
I don't have a QR code, but.
Thank you.
Thank you all.
That was excellent. Thank you, Steve. Everly with FTI Consulting. Okay, and next we will be introducing Coleman Rowland, Head of Energy and Natural Resources at BKD CPAs and Advisors. And once again, thank you, Steve.
Thank you, Mark. Yeah, Jesse set the bar pretty high there with the QR code. Can you guys see my slides?
Looks good.
Yes.
You can. Okay, thank you. All right. Well, again, thank you all. Thanks for having me. This has been really good. God's will and Mark. So Coleman Rowland, I'm a managing director with BKD, CPAs and Advisors here in the Houston office. I've got a couple of roles with the firm. I serve as the national consulting leader for energy and resources, and as well, I'm leading our internal audit practice for the Houston marketplace. I've done a lot of work, 30 years of experience in oil and gas. I worked for Shell Oil Company in their upstream and midstream businesses in their accounting department, finance department. And then 23 years with Deloitte, and then just took an early retirement and jumped over to BKD this past year. I spent a lot of time with CFOs, improving the back office. The fancy consulting word is finance transformation. So if you think about all of the different life events that a company can go through, say a merger, an ERP implementation, a bankruptcy. I've sort of spent my career, working with CFOs, chief accounting officers, and controllers, just navigating through those life events is kind of my elevator pitch on what I've spent my career doing. And so I've just got a few slides here, and I just kind of talk about what's. It's probably not as sexy as some of the other topics that we've already talked about, but what's happening in the back office, what's happening in finance and accounting, in oil and gas. And so if you think about what we've been through this past year, right? What are we seeing in the finance and accounting and oil and gas? I mean, the collapse in oil prices has forced headcount reductions in virtually just about every oil and gas company that exists, just based on what we've seen with the demand destruction, COVID, the Saudi-Russian price war. It's been really kind of a black swan event. And so these groups are being asked to do the same or sometimes more work with fewer people. And when I say more work, Jesse talked about ESG. It's come up a couple of times here. In a lot of cases, ESG reporting is showing up in the back office and FP&A in the financial reporting arena. So that's another set of tasks that's being put on these departments. My fourth bullet there on the slide, the push to professionalize accounting and reporting, right? So with the explosion of the SPAC, or at least becoming more popular. It's been around for a long time, but it's certainly very popular these days. So there's a push in a lot of these companies to, I'll say in air quotes, to professionalize the accounting and reporting function. So to get the accounting and reporting improved to a point where it's up to a public company standard. Right, and so that's another demand that's being pushed on, and finally, oil and gas companies historically have generated just a massive amount of data, and I'll talk about this a little bit more on the next slide. But essentially, there's an opportunity with some of the software that's out there to do something. To gather insight from this mountain of data. I've had several oil and gas clients that had all the data, but they didn't do anything with it. They didn't get insights from it. So with AI and machine learning coming into being much more popular and easy to use, the discipline of data science, companies are starting to take advantage of that tsunami of data, as I call it. So what? So what are companies doing about this? So to try to respond to doing more with fewer people, really two large efforts we're seeing in our clients. One is standardization and one is automation. So standardization of systems. So whether that's balance sheet account reconciliations, but just I've had clients that have done acquisitions, you know, global oil field service companies, for example. I've had some that have a real strong merger integration discipline where they acquire a company and they pull it onto their single instance of SAP. I've had other clients that they've done dozens of acquisitions over the years, and they've got every flavor of ERP, whether that's SAP, Oracle, JD Edwards, multiple versions of those, and that turns into a nightmare. And so there's something to be said for standardizing on systems, as well as standardizing on accounting processes. And then automation. There's really kind of, and the way that I view the world, there's really kind of three flavors of automation. And again, once again, software as a service, these tools are starting to become very affordable and very easy to implement and use. So the first area of automation is financial close automation. And I'll throw out a few vendors here. I'm not advocating any of these vendors, but just to give you a flavor of what we're seeing in the market. So Blackline and Trendtech are examples of financial close automation tools where, you know, a lot of times an accounting group will have, you know, so a key internal control when you're closing the books is the balance sheet account reconciliation. And I've had many clients over the years that have just done Excel, and not just a standard template of Excel, every version under the sun. So there's varying definitions of what a balance sheet account reconciliation looks like. Blackline, Trendtech are examples of simple software as a service tools that tap into your general ledger, and they automate a lot of the manual tasks that have you know, traditionally been in place. And so you're eliminating errors, and you're making it more efficient and more effective. So that's a way to combat that, doing more work with less people. The second automation bucket that I talk about is RPA, robotic process automation. And so I've had a colleague that the way that they describe what robotic process automation is, it's software that runs software. So if you can imagine you're doing a task at your desk, and you go to the web and you grab a commodity price off the internet, and you plug that into a spreadsheet and run some calculations, and then you turn around and input that into your ERP system. RPA tools like Blue Prism, Automation Anywhere, UiPath are some of the popular ones. That automates all of those keystrokes that I just described. And you basically train the bot, and it does it automatically. And so the individual, if you think about, you know, so a lot of people have a knee-jerk reaction to that is, oh my gosh, this robot is going to eliminate my job. Well, no, that's not what we're seeing. What we're seeing is it's the bot is doing the mundane, repetitive work that lends itself to human error, and the human is overseeing that and handling the exceptions, sort of upgrading their work environment. And then finally, the final automation bucket that I think about is around financial reporting, MD&A, and other reports. And so there's a tool like Workiva and is a popular one. And so if you think about when you're doing your SEC financial reporting, you've got footnotes, you've got disclosures, MD&A. What Workiva and those types of tools can do is they link all of the disclosures all the way back into the financial statement. So if you make a change in the financial statement, it will automatically flow through into all of the disclosures and flow the changes through automatically. And this is my final slide. I'm just going to shift gears a little bit and just talk about analytics and insights. So if you think about reporting and the use of artificial intelligence and machine learning, right? So machine learning is really based on a historical data set. So you have a data scientist, and they start running algorithms based on a historical data set. They can predict things in the future using the algorithms and data science. So if you think about kind of the evolution of reporting, right? So what we're all used to is what I would call descriptive reporting. So that's looking in the rearview mirror. What happened last year, last month, last quarter, just based on historical data. Well, with AI and machine learning, we can start to kind of improve and evolve, so to speak, right, on the sophistication of reporting. And so predictive is, once again, using machine learning and AI is what will happen. Again, based on a historical data set, what do we think is going to happen in the future? And then continuing up the continuum or the sophistication curve is prescriptive reporting. So not only is using the historical data set of what do we think is going to happen, but also make recommendations and suggestions based on predictive insights. So probably more than you wanted to know about what's going on in the back office, but there's, I guess, the kind of the punchline of that is there are tools and software available that companies are starting to take advantage of that have a pretty achievable ROI and a payback period, and it's a way that CFOs and controllers are trying to combat the headcount reductions that we've seen over this past year. So I'll stop there and hand it back to Mark.
Perfect, excellent. And that was Coleman Rowland with BKD CPAs and Advisors. Thank you very much. If you don't mind sharing your information or connecting with Coleman. Yep. And our final speaker, and then we're going to go into Q&A. We're going to go into Q&A, is JP Hansen, Head of Oil and Natural Resources at Houlihan Lokey. JP Hansen.
Thanks, Mark, and hello, everyone. I'm going to take a little bit of a different approach. We have plenty of data, plenty of materials, but I enjoy seeing people's faces. So rather than going through slides, I'm happy to share if anybody wants to hit me offline and talk at length about what I do and what we are seeing within the oil and gas group and broadly within energy at Houlihan Lokey, and happy to share plenty of data, but I'm going to keep the slides off the screen and just talk for a little bit. So for those who aren't familiar, Houlihan Lokey is a global investment bank focused on the middle market. We're 1,600 bankers, 24 offices globally. I've been with the firm for 20 plus years. I come from an oil family, much like Jesse mentioned. I've got a grandfather who, coming out of the Great Depression, had a bit of a Jed Clampett type story. But I went, rather than following my grandfather and my father as rigmen and landmen, I took the easier route, at least so I thought, and ended up in finance. I started my career as an oil and gas investor for approximately 9 years prior to joining Houlihan, as I mentioned, about 20 years ago. The oil and gas group that I run at Houlihan spans everything, all of the segments within oil and gas. We have a broad energy practice that covers power and utilities as well. But within the oil and gas group, we cover upstream, midstream, downstream, oil field services. It's 76 bankers now globally across 6 of Houlihan's 24 offices. Houlihan is the #1 middle market M&A advisor across all industries within the US. We are also #1 in the middle market in M&A and A&D advisory within the US. We have been for several years. We run a broad capital markets practice as well, focused as specifically on private placements. We are the #1 private placement investment bank. We place about $1.5 billion every month in private capital. we also underwrite public capital offerings as well. We have a 10-person A&D team. So a real breadth of experience to rely on. With respect to what is happening in the oil and gas, M&A and A&D and capital markets environments, starting about late third quarter 2020, early fourth quarter, we experienced a very broad resurgence in activity in oil and gas, particularly in M&A and A&D, supported by the capital markets. And what that has turned into through the year to date in 2021 is honestly the most active M&A and A&D market that I have experienced in many years, maybe as much as a decade. How do
you define middle market for the audience?
100 million to 5 billion. So that's the very traditional investment banking definition of middle market, is 100 million of total enterprise value to 5 billion of total enterprise value. So really looking at the small to mid cap market cap companies.
Super. Are there any particular basins experiencing more or less M&A or A&D, JP?
No, it's actually been pretty broad, and it's been broad not only in the US, it's been broad globally. I think it's easy to point to what has happened in the Permian and say that the Permian has been more active than other basins, but in reality, there are more operators in the Permian. So if you look at it on a percentage basis, it's not that the Permian itself has been more active, even though you've seen a number of transactions like Diamondback QEP, Diamondback Guidon, Pioneer, Parsley, the recently announced Cabot Cimarex deal that was announced on Tuesday, Laredo, Sabalo, which is a transaction that we are directly involved in, we're advising on, Surge, Grenadier, et cetera. Those are all Permian based companies, but the Bakken, the Williston Basin has been very active with Equinor selling to Grayson Mill, Enerplus acquiring a portion of Hess's position, Enerplus acquiring Bruin. The Eagle Ford has been very active with Oventive selling to Validus. Cimarex, prior to the merger, the announced merger with Cabot, sold a significant asset to Mock Resources in the Mid-Con, obviously in Appalachia with QEP acquiring Alta Resources. So across basins, there's been a very high level of activity.
Excellent, excellent. Are buyers valuing just production, or is there allocated value to undeveloped assets as well?
No, there has been, but that's one of the dramatic changes that we've seen. Going back to 2019, there was a shift in market appetite towards high production assets. And that was really a drive towards cash flow. The investors have been gravitating, not surprisingly, towards capital performance and cash flow away from what had been a 7, 8, 10-year run of real production, focused on production growth. Now the oil and gas industry has shifted and investor appetite has shifted away from growth at all costs towards cash flow and capital performance. And so there has been a period of 18 months or so, which had been much more focused on acquiring only cash flow producing production. Really, since this resurgence starting in the fourth quarter of last year, we've seen an uptick in value allocation to undeveloped assets, as well as production. The discount rate that's being applied to production has reduced, meaning buyers are paying a higher price for production, but there is dramatic value being allocated to undeveloped acreage. And if you look at any of those deals that I mentioned that have been announced, and you pull through what has been the value allocation, let's take, for instance, the Enerplus Hess deal in the Williston Basin. That was a $312 million acquisition that's producing about 4,300 barrels a day. If you apply what is a traditional Williston Basin per flowing barrel cash flow metric to the 4,300 barrels that are being produced, that results in about 155, 160 million of the 312 million that is applied to producing assets, which means there's about 155 million of value that's being applied to undeveloped acreage. That is very similar to what we saw in the Permian with Surge buying Grenadier's acreage, which was a $420 million acquisition. About 300 million of that is producing assets. So about 120 million of value is being attributed to undeveloped acreage. The list is long, and part of that is driven, the resurgence of value being allocated to undeveloped acreage is being driven by producers realizing that they may not have as much tier one inventory remaining. There's been so much drilling activity over the past decade that there isn't as much tier one inventory available in the US as originally believed, as companies have really churned through their tier one inventory. And so now that's driving value allocation back towards undeveloped inventory as companies need to acquire and replace that tier one acreage.
Interesting. Jesse or Coleman or Godswill, maybe Steve, do you have any points on what JP was just discussing with us?
Sure, I can add another point there. This great point about this, and we've been hearing about this for years, that we're drilling out all the best acreage. There's not as how much tier one acreage is left in terms of its productivity. And from an econ standpoint, we always have to be, from the way we think about it is, tier one is kind of a moving target. Over the last several years, as technology and methodology has improved, that what qualifies as a tier one acreage has kind of been a moving target. And so you have wells drilled today that on a per horizontal foot basis are more productive, even though 4 years ago, they might not have been regarded as tier one acreage, but it's as we're more productive as any well that was drilled at that time. And so we really got, so from our perspective on the econ, we got to kind of sort of be mindful that the rock, the quality of the rock is in some sense, from an economic sense, is a function of the technology that's being applied, and technology does continue to improve. It's certainly is a challenge, but that is sort of a moving target when we think about when we stack up our wells and think, where's production going? What if we do this under these price scenarios? What does this justify? That productivity growth question is always, per well is always a question. And it's always quality versus technology. What assumptions do we want to make?
Yeah, and Jesse, it's a great point that you're making. Obviously, the evolution of technology, of improved drilling and completing methodologies has improved dramatically. If you take the Williston, for instance, right, because it's a relatively new basin, so you can point to some really key data points in a short period of time. If you look at when the Bakken had a real growth spurt initially in 2012, 2013, a tier one well in the Bakken was thought to have an EUR of 500,000 to 600,000 barrels. And tier three acreage was not even on anybody's map. You fast forward to today, what was considered tier three acreage those wells, because of improved D&C methodologies, those wells have 700 to 800,000 EURs. And the tier 1 acreage now has 1.2 million to 1.3 million EUR. So everything has been elevated on a productivity basis per well.
Interesting. And this is a question from the audience, from Chris Paul. And audience members, please feel free to chime in and ask your questions. We have about 45 minutes and a panel of experts with us. So Chris Paul asks, what M&A activity is Houlihan seeing in the energy services space?
I think Jesse touched on this in particular in his slides. The oil field service sector is the hardest hit. It is a sector that lags other sectors of oil and gas, and is more a price taker in terms of it's a highly competitive sector. And unless you have some real proprietary differentiating technology, you end up being more of a price taker than a price maker. And so as a result, the M&A opportunities within oil field service have diminished greatly. That very well may change as you're seeing many companies try to pivot and create more proprietary technology. And even you're seeing some oil field service companies that are coming to the forefront of ESG. They're taking what has been traditional technology and applying it to wellhead metering, applying it to methane tracking, applying it to recycling of natural gas being produced at wellhead back into production so that it's not getting emitted. And those companies that are able to recreate themselves or reapply their technology are getting the most interest, and they're getting the most interest from the large independents and the majors within oil field service. But the M&A environment for OFS right now is pretty tough.
Okay, fantastic. Thank you, JP. And you mentioned ESG. Coleman also mentioned ESG. With regard to ESG reporting being a net new item in the back office, can you tell me more about what that looks like?
Yeah. So this has come up a couple of times in this discussion. You know, the SEC announced an ESG reporting task force in March, basically a watchdog to ensure that the investing public is seeing complete and accurate ESG reporting, with consequences for not doing that. So a lot of people look towards ESG becoming a regulatory event, and just this week, I believe it was this week, President Biden signed an executive order around climate change. The view of ESG reporting being a net new item in the back office is, if you think about and it's not just oil and gas, but the SEC financial reporting discipline that is required. It's very specialized and a lot of internal controls around it, and it's got to be right. There's a lot of rigor and discipline around SEC financial reporting in the back office. There's a very similar look and feel to people that are really embracing ESG. They've got internal controls around the data, transparency around the data and the reporting of it. And so ESG reporting, what we're seeing is ESG reporting is landing in that same department for the reasons that I just described, that there is a required level of rigor and discipline to get that reporting complete and accurate.
Fantastic. And JP, will the moves towards ESG change the relationship between independents, the small and the large cap, and the majors?
It's a good question. it's I think it's very, very early stage. I think it's evolving, but there is a bit of a mindset that right along the lines of President Biden's executive order and what the SEC is tasked or mandated now towards ESG compliance for reporting purposes. That's going to hit publics and majors first before it hits privates. Now, the private companies that are ESG compliant are going to get more highly valued when it comes to M&A and A&D activity, particularly in their interaction with publics. But there is a bit of a mindset right now that maybe we'll see a bit of a reversion to the 1980s, 1990s, where privates and private equity-backed independents were a bit of the R&D engine of the industry. They were out finding, they were doing a lot more of the exploration. And then once they found the reserves, they were selling to majors. The view being that if privates can deploy capital in very targeted ways and apply ESG metrics at the wellhead, it takes the pressure off of the large independents and the majors from having to take on ESG burdens with exploration out of the gate. And so there could be a bit of an evolutionary process where you see more consolidation occurring between privates and publics than has been experienced over the past 5 to 10 years.
Interesting. Jesse or Godswill, do you have anything to add, seeing as we are speaking about ESG?
Sure. That was a great point that JP just made about the R&D engine. Sort of one of the catch-22s that when we kind of think about it in that regard is that for a lot of the ESG, if you're thinking, Paris Climate Accord kind of status, you get your scope 1, scope 2, scope 3, the very limited effect on scope 3 from a producer standpoint. That's the consumer side. So your scope 1 emissions are all going to be in the production and distribution process. How do you get it out of the ground, get it to the market? That's where your focus is. And a lot of the technologies, at least as they currently stand, particularly you're thinking about EFRAC, you're thinking about certain other, no routine flaring, and other sort of investments to say, well, we're going to make sure that our gathering capacity that we're the contracting with everything is minimizing methane emissions. Those are all expensive. And since that advantages larger firms against smaller firms, there's a question on whether or not smaller firms, at least in near term, are going to be able to afford some of these technologies. There's, especially given that at least in the near term, the cost, there's so much, especially on the frac side, there's still so much spare equipment lying around. Like telling your investors, we're going to make our ESG metric but we're going to spend money on these more expensive EFRAC equipment when there's this cheaper equipment lying around. You're going to give up profit. You're going to give up what little margin you have in order to meet these ESG requirements. That's a tougher nut to crack for some smaller operators, some smaller service providers. So near term, I think that it's going to be a real challenge for the smaller companies to meet that agreement. That being said, when we do talk to OEMs, what we're hearing is that what new orders for new equipment they are getting is all driven by ESG. So it is all EFRAC, it is all flex fuel, so we can get some more natural gas burning where we can maybe recycle some of that natural gas to power our equipment. That's the drive when there are new orders, which are trickling in now, that is the focus. The question is whether or not, which companies have the resources to access that, because it is still very pricey.
Excellent. Interestingly, Jesse, along those lines, one thing that we are seeing in the capital markets is that there is a new sustainable loan environment where lenders are providing an incentive or a break on cost of capital for hitting sustainability ESG metrics. That's happening both in the commercial bank or reserve-based lending, the traditional RBL lending environment. There's also talk of public high yield being driven by high yield investors saying, you know, I would give you, I'll charge you an 8% bond, but I'll give you 100 basis point, a 1% break, as long as you take the equivalent of that 100 basis points and you're putting it towards ESG metrics. You're deploying capital at the wellhead, you're using EFRAC, you're improving the hatch environment at your storage tanks, you're putting metering systems on your wellheads, things that are actual measurable. I'll give you a 100 basis point break on your cost of capital.
Yeah, the pressure's coming from a number of different places. Yeah, I've heard the same thing, JP.
Thank you.
And to all the panel members, JP, you can start. How is ESG factoring into conversations in the boardroom and the investor community?
Well, I think we've touched on a lot of this, right? And I think Steve, from a public policy perspective, will have great insights into this. When you get into the boardroom, it's that blend between the public policy items that Steve touched on and what board members, directors are worried about as good stewards of assets, both in terms of, you know, the nuts and bolts of reporting compliance, as well as just being, you know, good stewards and not having the bullseye on them for not being appropriate and good operators of assets. And so every boardroom conversation, when you're talking about, be it a transaction, be it a deployment of capital, is focused on how do we ensure that we are not only going to be ESG compliant, but that we are improving our metrics quarter on quarter, year on year, so that we can attract that lower cost of capital. We can attract buyers to our assets who are paying up or attributing value for ESG compliance, et cetera.
Thank you, JP. And Coleman mentioned this earlier. Steve, do you mind chiming in on whether companies are changing their tune on energy issues as a result of the Biden administration's new focus on climate?
Well, I mean, the short answer is yes. I would say in a lot of cases, some of these companies were kind of changing their tune even before the Biden administration. I think there's been a directional shift here and kind of a broader momentum that predates November 2020, January 2021, whatever. That's been kind of years in the making. I do want to jump back real quick with the ESG discussion. One of the challenges we have kind of in the public affairs, environment is, what is ESG? It can mean pretty much anything to anyone. There are some reporting frameworks. I don't want to dismiss any of those. There are obviously some reporting frameworks that are out there. When you get into sort of a regulatory mandate discussion, that's when it gets a little bit more difficult. And frankly, I think there's a little bit of anxiety there. One of the jokes I've seen is, that, pretty much anyone on LinkedIn is an ESG expert. And that they put it on their profile because, yeah, I'm an ESG expert. Everyone is. I think ESG might be on my profile, so this is self-deprecating. But I think that's part of the challenge too. Is that for a company, for example, that's doing EFRAC, or that is shifting their operations away from diesel to natural gas or something along those lines, they're obviously going in the right direction, but there's an eye of the beholder element here as well in terms of public pressure that says, if you're still using fossil fuels, if you're still doing this, if you're still using it to produce oil and gas, that's not really the spirit of what we want. Whereas other people will say, no, that actually is. If we're going to produce it, we need to have it under this proper regime. So it's not only a kind of a capital markets discussion. I think it's also a company reputation discussion. And then the challenge that you get in there is, avoiding a situation where it's greenwashing, where you're just sort of putting it forward to say, hey, look, we care about ESG because we did X, Y, and Z, or that we're committed to this, or we've got this rhetorical flourish. Things are a lot more sophisticated now, and people are focused on this so much more. You actually have to, walk the walk and not just talk the talk on that. So I did just want to kind of insert that in there, just from our perspective, that it's complementary to what JP and others have been saying on here.
Excellent.
Yeah, and Steve, right along those lines, if you look, there is a growing number of companies, and not just majors, right? Obviously, Shell and Exxon are a bit in the crosshairs right now over the past 48 hours. But even independents, there's a growing number that are posting on their websites ESG presentations, ESG mandates, what they are doing with their assets to become not only ESG compliant, but improve their operations overall. And you're seeing it trickle into compensation for executives, right? Oxy, for instance, came out with 30% of executive compensation is tied to year-on-year improvement, and they have very concrete performance indicators as to ESG improvement on a year-over-year basis.
Excellent, fantastic. And Godswill and I actually sit on the board of SIPES, Society of Independent Professional Scientists, which is more lower middle market, E&P professionals. And we've had a couple of ESG presentations here recently. And in speaking to the members, a lot of them don't realize that, what's actually going on. And some of them weren't actually interested in ESG, but, in listening to this conversation, it's definitely something that they definitely want to be listening to. So excellent. Godswill, do you have any pointers on that?
Oh, yeah. Yeah, I have a question. So here's the thing. So US LNG exports, set an all-time record in March 2021 at about 10.5 billions of cubic feet per day production, and averaged about 9.2 billions cubic feet per day production in April. Now, the most exported LNG for those months since the United States began exporting, since 2016, that was just the most. But, but throughout 2020 and in January 2021, more than half of the US LNG exports went to Asia. However, in February and March 2021, more than half of the US LNG exports, went to Europe as a result of the spot natural gas prices in Europe, reaching levels similar to spot natural gas prices in Asia. Now, since we expect the LNG exports to average about 9.2 billion cubic feet per day in both 2021 and 2022, up from about 6.5 billion cubic feet per day in 2020, how will these dynamics and the clean energy policies affect gas commodity capital markets as managers and continue to rebalance their portfolios, going forward? And this is open for anybody that want to take the answer.
Jesse?
So, so when we think about LNG going forward with all of these metrics, obviously, part of that, we've already mentioned, there's from both on the ground and from satellite measurements of tracking the methane emissions from the infrastructure. What does that do to the overall carbon footprint? Especially if we go into a carbon price world or a carbon constrained world where we've got a carbon tax and a border adjustment or a carbon club, as it's called, or if you have a multinational carbon tax with border adjustments. What does that do? Well, what it does is it makes the price advantage of natural gas versus other things, it erodes that. It doesn't necessarily delete it. It just depends on, exactly, where's the gas coming from. And also, I saw something interesting. There's other things going on that's sort of new to me. This is with Total's recent supply of the LNG to a steel maker in Japan, and it was Total sold this natural gas from their global natural gas portfolio. It was a sale from their portfolio. And so there's some talk now where, if you have, say, sustainably sourced, so almost like certified fair trade or something, where you've got, natural gas, we say, well, our portfolio of natural gas supplies includes biogenic, it includes, capture from confined animal feeding operations or other sort of more environmentally friendly natural gas sources. And so that gets a stamp of approval. Like, this is, forgive the pun, certified organic natural gas that we're supplying. And so there's some competition there that might sort of be an interesting side effect of it. But we're also global population. We're at about 7.5 billion. It's going to go to 11 billion, and they're going to need more natural gas. And a lot of those people are going to be. This is the part that's sort of left outside when we talk about a lot of these things. A lot of those people, most of those people, are going to be consuming on an annual basis almost as much, if not more, plastic than we are right now. Hopefully, we can. There's some recycling improvements, but a lot of that plastic is going to come from natural gas supply chain. From the natural gas supply chain, it's going to come from ethane and propane processed from these facilities, processed as a result of this, as a side effect of this LNG. So there's a lot of things. I think a lot of things moving in the right direction for natural gas. To the extent that we can get a handle on the methane leaks side of it. Again, there's a lot of disagreement right now still on just exactly how big the problem is, how much of it is from legacy wells, how much that have been abandoned, how much of it is from infrastructure that exists. But I was in a conversation a few months ago with the National Renewable Energy Laboratory, and they have this fantastic resource called the LCA, Life Cycle Analysis Harmonization Project. And this is a huge effort to try and get to some type of aggregate measure of the life cycle carbon footprint of various types of energy. And it's various forms of energy. In this case, we were talking about electricity. And when you look at, say, methane emissions, and you start calculating what methane leaks do to natural gas supplies of some regions, that, in many cases, it could put it on par with coal in terms of its overall carbon footprint. That's not good. So there's a lot of things, the moving parts there, but I think just the population move alone, you're going to see LNG increasingly be a big part of the global energy footprint. It's just a question of, in a carbon constrained world, what are we doing to contain some of that carbon cost that will at some point be applied to the LNG.
Interesting. Coleman, do you have any thoughts on that?
Yeah, I mean, where Jesse and I live, and I think JP also, in our backyard, the Texas Gulf Coast is littered with huge petrochemical refining operations that has a huge appetite for natural gas. I mean, it's that's not going anywhere anytime soon. So it's going to be interesting to see how it plays out.
One thing I would chime in here too, just looking at the theoretical conversation, the policy discussion, but also just kind of looking at reality and what some of these other countries around the world are saying in response to different things, in response to some of these changes. The International Energy Agency just came out with this big earth-shattering report saying if we need to meet our net zero targets, no new oil and gas fields. And it was, this big eye-opening event, right? Since then, I believe it was Vietnam came out and said, basically, that's a nice report, but we're not going to listen to that. We've got a lot of people that we need to bring into, civilization, into, first world, standards of living, everything else. Japan pushed back on it. I did see something, I don't remember the exact group, but it was a group that has connectivity into several countries in Africa, also said something probably even more forceful. So we see these things that are, okay, here's the direction we're going towards net zero, we're going towards that. And I think we can all agree that that's where things are headed. But there is going to be, we're all going to get smacked in the face in some sense about what reality is, and that there are over 1 billion people that barely have any access to electricity. People living on less electricity than what our refrigerators use. 20% of the whole world has even been on an airplane. Like, I mean, the gap between our discussion here in the United States and everywhere else around the world is so huge, and a lot of people don't fully conceptualize that. So when these reports come out and when these projections come out, I think it's important to understand where things are headed, while also recognizing, like Jesse said, natural gas is going to be, there's going to be a lot of that around the world. It's just a question of, what does that framework look like? We know the direction, but methane, carbon taxes, border adjustments, those kinds of things, how do we get to that point, as opposed to, is it going to be there?
JP, chime in. Oh, go ahead. Sorry, Jesse.
And let's not forget the morass of carbon offsets and carbon offset accounting that is going to come along with that. A ticket to pollute.
Excellent. JP, how might the recent Exxon board seats allocated to engine number 1 alter the current dialogue?
Well, I think it goes right in line with this, right? I mean, engine number 1 is trying to change. Their whole push is to put a alternative energy mindset within majors, Exxon in particular. And the fact that a fund that owns 0.02% of Exxon shares was able to rally enough support from other shareholders to gain 2 seats on the board is a really dramatic statement by the investing universe that majors, not only because of policy change, not only because of the ruling out of The Hague against Shell yesterday, the investor universe has an appetite to see these changes. Now, exactly like we're talking about, like Steve mentioned, there is a division globally that is occurring between the OECD countries, the developed world, and the still emerging countries that are very, very much in need of hydrocarbons. And that's not going to change. And it won't change. I mean, you look at the LNG demand, God's will, to your question, part of the reason why Europe had a big spike in LNG demand in February and March is they had an unexpected cold snap. They are pushing towards getting away from hydrocarbons, and yet you can't flick the switch. We all have energy needs. We have personal energy needs. We have public energy needs. And that as much as the desire may be there, we can't divorce from what has been our 100+ year infrastructure, and change even the developed countries' overnight, let alone the developing countries. And so the real question then becomes for companies like Exxon, where now there are 2 board members who are going to put an ESG or alternative energy mindset into the boardroom of Exxon. How do you improve not only the reporting metrics, because it's one thing to check the box on reporting, but how do you actually change the dialogue and change the mindset so that we are trying to improve while we are still producing hydrocarbons? We're trying to improve carbon capture. We're trying to improve methane emissions. We're trying to improve the recycling of water, the recycling of natural gas, so that we're not adding to our carbon footprint, even though we still are wedded to and are going to be for decades to come as a world globally, we're going to be wedded to hydrocarbons. It's just reality.
And thank you for that, JP. And what are your thoughts on, the energy transition, with regard to nuclear. We're seeing a lot coming out of the SPE, Society of Petroleum Engineers, and AAPG regarding geothermal, just a whole energy matrix that works together with the current oil and natural gas that we're using.
I mean, I think if you look at the power side of the equation, right, the forms of energy production that plug into the power grid, be it solar, wind, geothermal, nuclear, that is a much more developed segment of the overall energy picture relative to oil and gas. Oil and gas, if that side of the equation is in the third or fourth inning, we're still playing spring ball in oil and gas. There's a catch up that needs to happen in oil and gas, but those alternative power generation options need to be further explored, and they are, they're continuing to gain traction, not only because you're seeing improvements in solar cells, you're seeing improvements in geothermal capture, you're seeing a reemergence of nuclear, even in countries such as Japan, which was so hard hit by the tsunami that they took all nuclear off. They're now bringing it back because it does need to factor in.
Excellent. And so Coleman, can you give us an example of how machine learning is being used in oil and gas? And Godswill, if you want to touch on that, and any of the other panelists as well.
Sure. Yeah. So I had a real client example of a story of how machine learning was used in an independent E&P company. And this example is not in the back office; it's in the operations. But so you're driving down the highway and you see the pump jacks, right? The secondary recovery that's the sucker rods that are working to pull the production out. This particular company was having a really hard time with rod pump failures. So that's a key part on the pump jack, the horse head that's moving up and down. And so again, as I mentioned in my prepared remarks, right? So machine learning, you're using a historical data set and you're applying data science and algorithms on that data set to predict the future. And so what they had some like close to 100 rod pump failures, and that was causing 30 days of downtime production on each well on which that happened, because they had to get the part out there after it failed and make the repair. So what they did was they started running the algorithms against that historical data set around rod pump failures. And they basically, long story short is, after several iterations, they were able to predict with 85% accuracy when that rod pump was going to fail within a 5-day period of time. So they had the part out there and available. So their downtime was much lower than historically. And so some might say, why don't we spend our efforts trying to figure out how to make a better rod pump? But the point is that they were able to use that historical data set and I mean millions of dollars and not having downtime in production. So it's a pretty compelling story.
Godswill, any thoughts on machine learning in oil and gas?
Well, of course, we know, and Steve had, we all have talked about the impact of methane, reducing gas emission, such as methane from hydrocarbon operations. It's one of the most cost-effective and impactful methods, to help reach that global climate and environmental goals. And we know that methane is more than 80 times more potent in trapping heat than carbon dioxide. And so it's important that we have, a system that will interface with some kind of gas analytics using artificial intelligence. And this should provide some kind of facility operators with an easy to interpret, colored visualization of maybe the gas plume, the location, the direction, the size, the concentration, and which allows for, sort of like an earlier or a more effective response, before the leaks have the chance to grow into bigger emissions. And this is something that Jesse had talked about in terms of, controlling the methane, leaks and gathering facilities and pipelines. So if we're able to use, a system, where we can interface gas analytics with artificial intelligence, we'll be able to detect, leaks of this nature on time and be able to address those leaks before they become a hazard. That's sort of where my thoughts will go in terms of artificial intelligence and machine learning. Thank you.
Excellent. Thank you. And JP, how might the recent ruling against Shell with respect to climate change impact operators?
Well, I think it's going to accelerate for all operators the concern that they're going to be next, that there's going to be some ruling that what they had mapped out in terms of improving ESG metrics and methodologies, that's insufficient, that a court is going to determine that it needs to be accelerated. And so I think it will only further increase the momentum in boardrooms towards trying to figure out how best to improve operations and implement compliance with ESG targets.
Excellent, thank you. And then with regard to public and private investors and looking at oil and gas companies, what's the main differences that you're seeing?
Well, it's, I think I touched on it a little bit. You're seeing both sides of the equation factor in some improved cost of capital, so long as measurable metrics can be hit on the ESG front. More broadly speaking, private investor mindset is migrating more and more towards, okay, how do I prep these assets for an exit, and what's that exit going to look like, and how long is the runway of capital that will be available to support that exit. Said differently, how long of this real robust M&A and A&D environment that we're currently experiencing, how long is it going to last? How long is this window going to be open? And do I need to hit it now? The public investor mindset is gravitating more and more towards companies who are publicly demonstrating that they are good stewards of assets, and yet, cash flow producing oil and gas companies. There still is a very, notwithstanding the discussion we've been having, the concerns that are growing for as citizens of the world, for us all with respect to ESG, there still is a very active public and private investor universe in oil and gas. It's just a question of, how do we best deploy that capital, and is it going to gravitate more and more towards those companies that are demonstrating year-on-year improvement towards ESG targets?
Fantastic, thank you. And then I'm going to open up the mics to the audience. So audience members, please keep your questions short. We have about 10 minutes left, and obviously we have the panelists here. So if you have a question, feel free to unmute yourself and ask either Steve, Jesse, Godswill, Coleman, or JP, or any of them to chime in. So feel free to unmute yourselves, and let's engage in a free flow discussion. And please keep your questions short. Thank you.
Can I just ask, isn't the future for oil and gas to try and diversify into renewables, because that's going to be the new growth area going forward?
I think it's a mix. I mean, if you look out at any reasonable forecast, you look out 2040, 2050, oil and gas will still be needed. It'll be needed in developing countries. It will be needed for all of the if you look at the percentage of oil and gas consumption, it is increasing in areas that have nothing to do with transportation. In fact, over the past decade, and Jesse, you may even know this better than I do, but globally, as a percentage, transportation consumption of oil has reduced from 44% to like 37% over the past decade. And whereas plastics and detergents and things that we've all been living with over the past, 15, 16 months, all the PPE stuff that we're wearing around or we're wearing around, like that's all driven by oil and gas. It's not going to go away. So what you're seeing is the majors, and this is part of the Exxon conversation that we were just having, the majors saying, okay, and Shell has a great program. I mean, they've got a whole division on Shell Ventures that all they do is invest in alternative energies. BP has exactly the same. They're looking at, okay, what are the diversifications as a major into alternative energy? But then when you get into the independence on a global basis, you're still going to have oil and gas companies 20, 30, 40 years from now.
My thinking is this. My thinking is that especially in developing countries, developing economies, it's going to take decades to actually build out infrastructures for the charging stations and for the EV vehicles and all that to actually transition completely to clean energy or to renewables. So what we're going to see is there's going to be that transition is going to might be rapid in developed economies, but it's going to slow down in developing economies, maybe like in Africa and all that. So it is not what people expect. You're just going to see a quick exit or a quick departure from fossil fuel or into clean energy, but that is going to be a gradual, and we might have to see that process, an ongoing process, even 20, 30, 40, 50 years from now. So that is just my perception about the situation.
Yeah, absolutely. And JP was right on the money there. Gasoline, motor fuel as diminishing as a share. And when we talk about 100,000 barrels a day of global liquids demand, this is the way we normally talk about. We normally don't say liquids, we say crude demand. We're using the IEA numbers. Embedded in that is this as natural gas liquids, ethane, propane, and butane. Butane goes into gas, it's dominated by gasoline, but volumetrically running forward, a big chunk of that is going into heating and cooking for propane, but petrochemicals. And when you look at, by the time we get to peak liquids demand, all right, and some people think that's going to be, like I said, a little before 2030 now. Some people think it's going to be a little after 2030. Saudi Arabia is still optimistic and saying it's not going to happen until 2040. But whenever peak global liquids demand hits, as we approach the end of this decade, almost all of the incremental demand growth is plastics from 2030 on, all of it. As from the natural gas liquids, or I should say, it's from the natural gas liquid side. It's from the very lightest end of the barrel. And so going forward, but also, and I think this is, it ties back to some of the population trends, some things that we've been seeing here. Even if you get to, and if you're imagining sort of a hyperbolic move here for new car sales, even if you get to new car sales being 60% of battery electric by 2030, and you just sort of imagine towards the end of the decade, you see a big scoop. Even if you don't see that, maybe it's 40%, whatever number it is you want to look at, there will still be more internal combustion engines around the world on the road in 2030 than there are today. And those internal combustion engines, yes, they'll be more fuel efficient than today's vehicles or last year's vehicles, but those internal combustion engines are going to be on the road for the next 10, 20 years. They're going to be much more reliable than the cars that we had 10, 20 years ago as well. And so there's going to be a base demand that's still there for oil and gas that, just as has been said, that's going to be around for many years to come, even not even though the total share will likely continue to decline as we move into plastics. The big bugaboo for plastics is how pronounced are we going to be able to go to back to molecule recycling? Meaning, how good are we going to be at closing the loop? And that could have an effect if we really make inroads on that technology. And this is like a 10, 15 year kind of proposition, because there's a lot of infrastructure for collection that has to be put in place. If we can close that loop, then that offsets the demand for new natural gas molecules.
Johnny, you had a question? John Ablante, you had a couple of questions, or any other questions from the audience? Feel free to unmute yourself and speak with our panelists.
One quick question. In my mind, the discussion about transition from oil and gas, you've got to consider batteries and rare earth minerals, the source of lithium and how you process it. I think that's going to hang things up.
It's exactly the comment I was about to make. Apparently, cobalt mining is resulting in tremendous injuries to children, and I just wonder how long will it be before that racket is exposed as much more environmentally unfriendly than anything that fracking and refining and all that other processes make.
Yeah. There are some inconvenient truths out there for sure.
Superb. Any other questions from the audience? We have a couple minutes left and we'll be wrapping up promptly at 10 a.m.
Yeah, I just one question, which was indirect to oil and gas. In Europe, a lot of major car manufacturers are going to cease production. In North America, for example, to go down the same route.
Can you repeat that? I think you were breaking up.
In Europe, a lot of major car manufacturers are going to cease making the internal combustion engine and move across to kind of like electric cars. They're just not going to make diesel or petrol-driven cars anymore. Is there any such move likely in North America?
California has announced something, I think it's 2030, 2035, that they will not allow gas-powered vehicles. I can't remember if that was just an executive order, if that's actually been fleshed out as a fully enforced regulation. There have been other kind of similar things. There was a decision by a court up in Minnesota that actually was going to allow something similar from California to potentially be used in the state, or at least it was opening the door. I'm not as convinced of that in the United States, just because of the liquid fuels market for transportation is not only intrinsic to what we do to get stuff around here, but also, even if I'm just being cynical, the political component of this in terms of who is defending the liquid fuels in the United States. It's not just, oh, the cowboys down in Texas are going to protect gasoline. You're talking about liquid fuels in Minnesota, in Iowa, the biofuels industry. These are people on the far left and the far right who are going to try to protect that market as well. And I think, just to kind of bring this back, I know we're kind of running at the end here, but in terms of, alternatives and in terms of other options, as those become more and more of the market, there's going to be a greater recognition that every single energy source has some sort of trade-off to it, right? Whether it's carbon emissions, whether it's where it's developed, whether it's energy security, whether it's supply chain. And as these things get bigger and bigger, there's a different discussion that happens. I don't think you say, okay, here's our discussion, here's the trajectory, and we don't even talk about it for 30 years. It's going to be sort of building off of different events and different things that we learn along the way. So, I think that, even over in Europe, announcing we're not going to, have gas-powered vehicles, they do have a different public transportation system than we have here in the United States. But I grew up in a small town in Kansas, and it would probably be the last place that you ever get rid of, trucks other than maybe parts of Texas.
Superb. And then I'll ask one final question and we'll close out. If you'd like to share your information in the chat so people can network with you, go ahead. And this is to Coleman. Regarding RPA, what's the typical payback period on RPA implementation?
Yeah, so when you're building a business case around RPA, right, it's a bit of, you know, when you're trying to understand the benefits, you're calculating hours saved on particular tasks. A typical bot, that can run, is about kind of the first bucket is about 50,000. So what we've seen when we're running business cases for clients is the payback period is anywhere from 12 to 18 months.
Excellent, fantastic.
Very important.
And then I want to thank all of our speakers. And if you could each just give just a brief overview of your thoughts on the state of the markets. If you could go first, Coleman.
Well, I mean, I think today was a good discussion. It's funny, I don't think we really officially had ESG as an agenda item, but what I'm finding is it creeps into every conversation I'm having with clients. And so I really appreciated the perspectives of the other speakers here. It's something that our firm is investing in. We see, we love regulatory events, and we think that might be where this is heading. And so we're leaning into, being a lifelong oil and gas guy, I'm sort of have mixed feelings about where the industry is headed, but we're leaning into it. And thanks for having me on, Mark.
Thank you, Coleman. We appreciate your viewpoints. Steve.
Yeah, I think, state of the market, where things are going, we like to not, go where the ball is now, but where it's headed, to try to catch it. And that's clearly headed towards the mix that we're hearing about and how things are, if the percentage right now is, X percent oil and gas, it's going to be, lower than that in the future. It's going to be more renewables. And, something that I'll just kind of, conclude on here as a sort of, optimist kumbaya kind of moment is that we often talk about oil and gas, fossil fuels, and we pit them against renewables. And we say, it's going to be renewables rather than oil and gas. If you go out to West Texas, you will see not only a lot of wind turbines, but you will also see a lot of companies that have partnered with renewable energy developers because they get price certainty from it. And if you talk to a lot of renewable companies in Texas, they will say, we love the oil and gas industry. They're our best customers. We sell them a lot of power. And I think that kind of mix and that kind of story often gets lost in the discussion, that there's actually a lot of harmony going on right now. And so again, I don't want to just, sit around here with the peace pipe necessarily and say everything's great for oil and gas because we're already working with renewables, but that's the market changing irrespective of other policies. There are price considerations and other things that companies are taking into account here that in some cases don't even have to do with environmental issues. It has to do with price. It just has to do with the economics of it. So I think that's an interesting component of the future of the oil and gas industry and how they continue to leverage that and continue to build that out in the context of, I'll say it again, ESG considerations and climate considerations.
Thank you, Steve Everly, FTI Consulting. Godswill Nwankwo, Asset Beta.
Okay, so I thank everybody for being here today. It's very interesting hearing the diverse perspective from all the industry leaders and experts that was in the panel. As a closing remark, I just want to, remind us, that we saw the U.S. crude inventory in Cushing, Oklahoma, as it fell by almost half a million barrels in the week ending May 21st. And the crude oil prices that were supported by, decline in the US dollar to a 19-week low versus a basket of currencies as inflation worries begin to recede, And as we know, a weak dollar makes it less expensive for holders of other currencies to buy commodities that are priced in US dollars like the crude oil. So with that said, I just want to kind of reassure everybody here that the outlook will continue to remain bullish, both in the short and the long term. So that is what I want to leave, message I want to leave with everybody here today. Thank you. Okay, Mark, I think you have your mute on.
Thank you, my party. I will go next to JP Hansen, and then we'll close with the Federal Reserve Bank. Thank you, JP. Thank you, Godswill.
Yeah, thanks all. Look, this has been it's been a very interesting and wide-ranging conversation. We're obviously from an energy industry broadly, we're going through a transition, and in a transition phase, in any transition phase, there's a lot of opportunity. And you're seeing those opportunities manifest themselves in a variety of different ways, be it with the recent robust M&A and A&D activity, the return of capital focused on energy. Energy is the best performing sector in the S&P year to date. And it's not just because it's coming off of a low base. It's because the industry has pivoted and operators are now demonstrating capital performance and cash flow, which is attracting investing dollars. Now, the other side of the equation on the transition is what we think about from a transitioning towards ESG. And I firmly believe that if we put the appropriate measurements and metrics in place to demonstrate that we can be good operators of oil and gas assets, that the industry has a long, long life ahead of itself, that the transition isn't just to flick a switch and move away from oil and gas, but in fact, to just become better stewards of the natural resources that we've all been blessed with.
Better stewards, I like that. That's a great summary. Thank you, JP. And then finally, if we could have Jesse Hansen.
Thompson.
Thompson.
Well, it's hard to top JP, so I understand you wanting to end with him. But what I would say is, this is such a strange time that we find ourselves in, with so many moving parts. To try to piece together an outlook is really challenging. But I'll say just a couple of things. Is that, from where I'm sitting, we've gone through this great super cycle with the shale boom, the shale bust, and now here we are at the dawn of the ESG age. And so moving forward, the rumors of the oil and gas industry's demise are greatly exaggerated. And as has been alluded to by all of the speakers here, the industry is currently evolving. And whether you're talking about, carbon offsets and CCUS and the way executives are compensated, or you're talking about the integration of AI and how this mitigates risk and improves efficiency, the industry going forward, there is going to, look very different. And what does this mean for employment? The kinds of energy jobs that are going to grow going forward are on balance. They're not going to look like the jobs of the past, but it is still going to be some growth. It is still going to be growth, and Texas. Steve made a great comment earlier, and I've written about this on the past. Texas is sort of in a unique spot. We have all of the components of where we are and where we're going. Whether you're talking about demographics or you're talking about energy mix, Texas is in the mix. Like we're at the front line of a lot of this integrating of different technologies, competing resources, and complementary resources. And thinking about where this thing evolves forward. I wish I could give you a forecast that says, here's how this is going to evolve. Tomorrow morning, we could have a news report on solid state lithium ion batteries that completely upends every single person's projection. I don't know. But the traditional energy isn't going away. It's going to be getting better. And there's going to be a lot of new technology opportunities in hydrocarbon, in hydrocarbon and in renewable hydrocarbons and in other electron-based technologies. And Texas, I think, is going to play an integral role there, just because we already have a lot of the talent employed here, solving real world problems. So I'm optimistic, but it certainly is a time of uncertainty when we look at the policies and where the policies on the top down side and the consumers on the demand upside.
Excellent. And thank you, everybody. Thank you to our panelists. Thank you to the Financial Executives Networking Group. If you're not a member and you're a finance executive, it's a great organization to be a part of. It's invitation only. If you would like an invitation, or if you'd like an endorsement, sorry, please reach out to me. I'm sure you have my contact information. I sent you an email. Once again, this is the State of Energy with the Financial Executives Networking Group. Thank you to all of my panelists and speakers, and thank you to everyone who invested their time with us today. Until next time, have a great day.